Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
$216.69. That was the specific closing price for Coherent Corp, ticker COHR, for the regular session on Thursday, February 12th, 2026.
And honestly, the closing price, it kind of hides the real story of the day. You have to look at the volatility. I mean, we saw the stock swing from a low of $211 all the way up to a high of $223.38 in a single session. That's just a massive intraday range for a company this big.
It is, but the volume is what really, caught my eye. The average daily volume has surged recently to 7.48 million shares. Now, if you compare that to the historical average, which sits closer to 4.9 million, the market is turning through this stock at a frantic pace. We are looking at a company sitting right near the top of a 52-week range that goes from $45 all the way to nearly $250. That's a 150% appreciation in just 12 months.
Which pushes the market cap to nearly $40 billion. And that, right there, brings us immediately to the central conflict we have to wrestle with today. Why is a company that, essentially bends glass, grows crystals, and manufactures lasers, why has it suddenly become the absolute darling of the AI trade? And more importantly, is a legacy hardware manufacturer actually worth 215 times its earnings?
See, the argument I'm putting forward today is that legacy is the wrong word here. Under CEO Jim Anderson, Coherent has pretty much ceased to be a conglomerate. It is now a pure play on the physical layer of artificial intelligence. We are in the very early stages of a supercycle, specifically in optical networking, that I believe could drive a 5-fold return. I'm looking at a mathematical path to a $200 billion market cap by 2036.
And that is exactly where I have to pull the emergency brake. I look at the exact same data points and I see a stock that is priced for absolute perfection. You mentioned the PE ratio. We're trading at a trailing price to earnings of roughly 215. The market is ignoring existential risks right now, specifically efficiency breakthroughs in AI software that could crush hardware demand, and a massive wave of state-subsidized competition from China. This feels like a hype cycle that is getting very, very long in the tooth.
I understand the skepticism on the valuation. I do, especially after a run-up like that. But let's just strip away the stock price for a moment and look at the engine under the hood. My thesis is that Coherent is transforming into the bottleneck for the data center build-out. You can have all the GPUs you want, but if you can't move the data between them, you have a traffic jam. Look at the fiscal Q2 2026 report, the one from February 4th. It was a clean beat. Revenue hit $1.69 billion. EPS came in at $1.29.
A beat is a beat, sure, but let's not pretend the market threw a parade for them. Despite that clean beat, the stock dropped nearly 18.6% after hours initially. That is not the behavior of a confident market. That signals deep nervousness. When you beat earnings and the stock crashes, it usually means the expectations built into the price were just impossible to satisfy.
That drop was a knee-jerk reaction, and it was largely driven by the Bain Capital exit, which we need to contextualize properly. But before we get to the shareholders, look at the demand visibility. The book-to-bill ratio in the data center segment is over 4.0x.
Okay, for the listeners who don't spend their days inside financial statements, let's just clarify that metric. Book-to-bill is the ratio of orders received versus orders shipped.
Exactly. So a ratio of 1.0 means you're shipping product just as fast as you're selling it. A ratio of 4.0 means for every $1 of product they shipped out the door, they booked $4 in new orders. Demand is outstripping supply 4 to 1. That gives them revenue visibility well into 2027. This isn't speculative. These are signed purchase orders from the biggest tech companies in the world.
But are those orders sticky? That's the risk of the backlog in a cyclical industry. If the hyperscalers, Amazon, Microsoft, Google, if they decide to cut back on CapEx, those orders can evaporate or get pushed out indefinitely. And speaking of people heading for the exits, we have to talk about Bain Capital.
You mean the block trade?
The massive block trade. On February 9th, Bain sold over 9.4 million shares at roughly $235. That was a $2.22 billion cash-out event. You can spin this however you want, but Bain is the definition of smart money. They sold 5 million shares last year, another 7.5 million later, and now they have exited the position completely. They sold at the absolute peak. So, when the private equity firm that helped build the company decides there's no upside left, why should a retail investor believe there's a 5x return waiting for them?
I view the Bain exit as a clearing event. Essentially a reset button for the shareholder base. Yes, it created massive selling pressure, which tanked the stock temporarily. But that overhang is gone. Bain is out of the building. The temptation for them to dump shares at the end of a quarter is removed. Now, 96% of the float is held by committed institutions who are buying the long-term story. And the story is about operational leverage. Under Anderson, the debt leverage ratio dropped from 2.3x to 1.7x. They are shedding the fat, selling the aerospace and defense business for $400 million, selling the materials processing tools. They are moving capital from low-growth areas to high ROI sectors. This is a disciplined machine now.
Discipline is great. I like discipline. But discipline doesn't justify a 215x multiple. You're paying software multiples for a hardware business. And hardware is hard. You have inventory risks, factory risks, yield risks, plus we have the DeepSeek factor.
The efficiency narrative?
Correct. This is the elephant in the room. The Chinese lab DeepSeek released findings suggesting that through better coding and optimization, AI models can become drastically more efficient. If software gets 50% better, you might need 50% less hardware to run it. The entire thesis of massive hardware intensity assumes that models remain bloated and inefficient forever. If the hyperscalers figure out how to do more with less, that 4.0x book-to-bill ratio you love so much could vanish overnight.
And that brings us perfectly to the core of the debate, the technology itself. Because I think there is a fundamental misunderstanding of how AI scaling works. Even if models get efficient, the sheer volume of data being processed is growing exponentially. The physics of data movement doesn't change. Let's dig into the optical networking side, specifically the transition to 1.6T, because that is where the immediate value lies.
All right, let's get technical. Why is 1.6T the magic number? Why does the market care?
It's about the bottleneck. In an AI training cluster, you have thousands of GPUs. They need to talk to each other constantly to update the neural network parameters. Historically, we use copper cables or, slower optics. But as chips get faster, the lag or latency between them becomes the limiting factor. We are transitioning from 800 gigabit transceivers to 1.6 terabit transceivers to fix this.
And Coherent makes the lasers that drive this.
They make the whole package, but the secret sauce is the EML, the externally modulated laser.
Coherent is vertically integrated. They grow their own crystals, specifically indium phosphide.
Indium phosphide. Okay, explain why that matters versus, say, standard silicon.
Sure. Silicon is great for logic, for thinking, but silicon is terrible at emitting light. It's an indirect bandgap material. Indium phosphide is a direct bandgap material. It generates light efficiently at the wavelengths needed for fiber optics. You physically can't send a signal down a fiber optic cable without a laser, and silicon can't be that laser. So Coherent is ramping up production of indium phosphide wafers at their facilities in Sherman, Texas and Järfälla, Sweden. And here's the kicker. They're moving from 3-inch wafers to 6-inch wafers.
Which sounds like a small change, just 3 inches to 6 inches, but in semiconductor manufacturing, doubling the diameter changes the economics completely, right?
It's geometry. It quadruples the surface area. That means 4 times as many chips per wafer, which crashes the unit cost. It's a massive competitive advantage. That's why their data center revenue grew 34% year over year. It's a step function increase in manufacturing capability that competitors can't easily replicate because handling indium phosphide is notoriously difficult. It's brittle, it breaks. Coherent has mastered it.
I'll grant you they are good at manufacturing, but they aren't the only ones. I look at the competitive landscape and I see sharks in the water. Lumentum is incredibly aggressive right now, especially after acquiring Cloud Light. They're gunning for the exact same hyperscaler contracts. And then you have the 800-pound gorilla, Marvell.
Marvell partners with Coherent on many designs. They provide the DSP, the digital signal processor, while Coherent provides the optics.
For now, but the industry is moving towards CPO, co-packaged optics. This is where the optics are moved right next to the switch chip inside the package. If that happens, the semiconductor designers like Marvell might just eat the lunch of optical module makers. If the optics become just another part of the chip, Coherent loses its premium status. The moat you mentioned is liable to be bridged by silicon photonics.
I disagree because the physics prevents it. Even in co-packaged optics, you still need a light source. You still need the laser. Silicon cannot generate light. You cannot defy the laws of physics. So Marvell might design the package, but they will still need Coherent's indium phosphide lasers to power it. In fact, Coherent already has a major design win that integrates their optics onto a switch ASIC package. They aren't being left behind. They are enabling the transition.
Even if they win the tech battle, I question the durability of the cycle. You're assuming this demand curve goes up and to the right forever. But look at history. Optical components are famously cyclical. There was a boom in 2000, a boom in 2010, a boom in 2022. Every time, the suppliers overbuilt capacity, prices crashed, and stocks got crushed. Why is this time different?
Because AI is not a standard telecom cycle. This isn't about people making more phone calls. This is about re-architecting the entire internet. The move to 1.6T is just the first inning. We're already talking about 3.2T. But let's shift gears, because Coherent isn't just about data centers. The other pillar of their growth, arguably the more speculative one, is silicon carbide in the electric vehicle market.
A market that is notably soft right now. Soft is actually generous. It's in a glut.
Soft in the short term, perhaps. But we need to look at the structural shift. The automotive industry is moving to 800-volt architectures.
Okay, let's pause and explain the 800-volt advantage, because most people just plug their car in and walk away.
Sure, most early EVs ran on 400 volts. Moving to 800 volts allows for much faster charging, filling a battery in 15 minutes instead of 45. It also reduces the weight of the copper wiring in the car because higher voltage means lower current. But to handle 800 volts without melting, you can't use standard silicon chips. You need silicon carbide, or SiC. It handles high voltage and heat much better. Coherent secured a $1 billion investment from Denso and Mitsubishi to expand this business. That is huge external validation.
That investment was necessary because the cash burn was high, not just because the tech was good. But look at who they are fighting in silicon carbide. This isn't just a battle with Wolfspeed anymore. The Chinese competition is fierce. Companies like Tanky Blue and SICC have grabbed the number 2 and number 3 market spots globally. Combined, they hold over 34% of the market share.
But Coherent is focusing on the premium end, the 200mm or 8-inch wafers. Most Chinese competitors are still struggling with smaller 6-inch wafers.
For how long? A year? 2? The Chinese government is subsidizing these companies to the hilt. Silicon carbide substrates are fast becoming a commodity, and when a product becomes a commodity, the price crashes. Coherent is trying to maintain premium margins in a market that is entering a global price war. They are fighting a two-front war: technological obsolescence in optics from CPO and commoditization in materials from China.
You're underestimating the difficulty of producing high-quality 200mm SiC at scale. It's not just about size, it's about defect density. If the crystal has defects, the chips fail. That's why Denso, a Tier 1 automotive supplier, put $1 billion into Coherent and not a Chinese competitor. They need reliability. When you are putting a chip into a car that drives at 80 miles per hour, you don't buy the cheapest substrate, you buy the safest one.
Reliability commands a premium, yes. But does it command enough of a premium to justify the valuation of the parent company? That's the real question. You're asking investors to pay for a moat that is being attacked by state-sponsored entities.
Let's talk about that valuation and the financials. You called it financial engineering earlier, but I call it the Lattice playbook.
Please explain the playbook.
Jim Anderson came from Lattice Semiconductor. When he took over there, the stock was stagnant. He ruthlessly cut low-margin products, focused R&D on high-growth areas, and optimized the supply chain, Lattice stock went up something like 10 or 20-fold. He is doing the exact same thing here. Non-GAAP gross margins hit 39% in the last quarter, up 77 basis points year over year. They're targeting 42%.
42% is impressive for hardware. I will give you that.
It's software-like margins on hardware products. By divesting the aerospace and defense business and the materials processing tools, they're cutting R&D spend that was spread too thin. It used to be 10% of sales across a messy portfolio. Now, every dollar of R&D is focused on high-growth, high ROI areas.
That sounds great in a presentation deck, but let's look at your 5x return thesis. You said $200 billion market cap by 2036. To get there from $40 billion, you need a compound annual growth rate of 17.5% for 10 years straight.
Which is achievable given the explosive growth of AI.
Is it? Let's check the industry data. The broader photonics market is projected to grow at roughly 5.1% annually. Transceivers specifically are growing faster, around 13, maybe 14%, but to hit a 17.5% growth rate for the entire company, Coherent has to vastly outgrow its own industry every single year for a decade. They have to steal market share in a growing pie while fighting off Lumagentum, Marvell, and China.
You're forgetting the margin expansion. It's not just revenue growth, it's earnings growth. Earnings are expected to grow at over 52% in the near term because of that operating leverage. As revenue rises, costs stay flat, so profit explodes.
In the near term, sure, but we're talking about a decade-long hold. Any slip in execution triggers a massive reset. If the 6-inch Indian phosphide ramp in Sherman, Texas faces yield issues, the stock crashes. If a major hyperscaler switches to a competitor for 1.6T, the stock crashes. Even the forward PE is sitting around 34. There is absolutely no margin of safety here. You are paying for a scenario where everything goes right.
I see the risk, but I view it as the price of admission. You don't get to buy the pick and shovel for the AI era at a discount. The bottom line could rise by over 400% in the next 3 years as the 1.6T cycle and optical circuit switching peak.
Peak being the operative word. Cyclical industries peak, and then they trough. Investors buying at $216 are buying the peak. And let's not ignore the geopolitical risk. Where does indium come from? Where does gallium come from? Primarily China. If trade tensions escalate, Coherent's raw material supply could be choked off. That is a risk that is not priced into the stock.
Or they are buying the breakout. The supply chain diversification is already underway. But let's bring this to a conclusion.
Lead the way.
When I look at Coherent Corp, I see the essential infrastructure for the next decade of computing. The physics of light, photonics, and the physics of power, silicon carbide, create high barriers to entry. You cannot code your way out of the need to move data with light or power vehicles efficiently. Software efficiency, like DeepSeek, cannot bypass the fundamental need for bandwidth. With the debt load reduced to 1.7x leverage and production ramping for 1.6T, the pathway to a $200 billion valuation is mathematically visible. It requires execution, yes, but the pieces are in place.
And when I look at Coherent, I see a great hardware manufacturer that is being priced like a software monopoly. The risks of geopolitical, material constraints are real. The DeepSeek efficiency narrative poses a structural threat to demand that is not priced in. Buying at an all-time high after a 150% run-up, with Bain Capital exiting the building, leaves you exposed. It's a game of musical chairs, and the music might stop sooner than the bulls think.
It seems we are at an impasse on the valuation, but a line that the execution in the next few quarters is critical.
Absolutely. The next few quarters will tell us everything. Specifically, we need to watch the cadence of that 1.6T ramp and whether they announce more design wins for optical circuit switching. That will determine if the premium is justified.
Indeed. There is certainly more to explore in this material as the numbers come in.
Always more to dig into.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.